There's more signs the US labour market remains resilient, while UK and European production is still contracting. South Korean growth disappoints as exports drag, and Japan's finance minister raises concerns as the yen slides against a resurgent US dollar. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ Chief Economist Richard Yetsenga looks at what lessons for the future China might learn from its current economic support efforts.
China will need more reform packages in the future of the type designed to stabilise the economy and try and boost growth than we have been used to in the last 10 or 20 years.
But first, in 5 and 5 with ANZ, the US economy's soft landing just gets softer and softer and seems to be barely landing at all. Jobless claims overnight were lower than expected, indicating ongoing strength in the labour market. That contrasted with PMI surveys out overnight in Europe and the UK showing ongoing contractions. Global markets were mixed, with the Nasdaq and the S&P 500 up between 0.2% and 0.6% by 4 a.m. Sydney-Melbourne time. That was thanks in part to Tesla's shares jumping 19% after Elon Musk predicted 30% sales growth next year. US Treasury yields fell 2 to 4 basis points, and the US dollar index fell 0.26% by 4 a.m. The Aussie dollar was flat at 66.33 US cents, and the Kiwi dollar was up 0.1% at 60.09 US cents. Number 2, Japan's PMIs dropped into contraction territory, a near 2-year low of 49.4. Key drivers were contractions in new export orders, business activity, and the largest decline in services business expectations since December 2021. ANZ FX analyst Felix Ryan says amid the negative headlines, there were at least some positives for the Bank of Japan as it looks to normalise monetary policy.
In the composite index, we saw output and import prices lift. So now that is in part probably reflective of the weaker yen we've seen over the last month, at least on the import prices side of things. But that also does suggest that there's still that underlying pressure building or at least maintaining its strength in terms of CPI within Japan. That does support our notion that Bank of Japan will continue with policy normalization going forward. We still have December as the next rate hike. We are looking at that 1% terminal rate to be reached towards the end of next year as well.
Number 3, staying in Japan, the weak yen has again attracted commentary from policymakers. Yesterday, the yen weakened to a point where 153 yen were needed to buy a US dollar. Although overnight it strengthened a bit to settle at 151.75 yen to the dollar as at 4 a.m. Sydney-Melbourne time. That's after Japan's finance minister warned authorities would closely monitor the currency's moves. Here's Felix again.
A lot of that has been dollar yen following the move upwards in US yields as well. We have seen quite consistently the last 2 weeks stronger US economic data really push back on some of those Fed rate cut expectations as well. As we get closer to the US election as well, there's also been some uncertainty around that, which has also driven some strength in the dollar. So that's really been driving dollar yen back up into that 150 territory and beyond.
Number 4, South Korea's GDP disappointed in the third quarter, rising just 0.1% compared to the market forecast for a 0.4% rise. ANZ economist Crystal Tan says it was the export side of the economy which took the hit, with goods exports down 0.6%.
Considering that downside surprise to Q3 growth rates was led by exports rather than domestic demand, which actually held up okay, we don't think a back-to-back rate cut by the Bank of Korea at its upcoming meeting in November is likely. So we continue to think that the BOK will next deliver a cut in Q1.
Number 5, Malaysia's CPI inflation rate fell slightly to 1.8% year-on-year in September from 1.9% in August. That was just below market forecasts for 1.9%. The annual inflation rate has actually been stuck there at 1.9% for 5 consecutive months. That's partly because of government fuel subsidies. ANZ economist Arindam Chakraborty says inflation is broadly stable for now in Malaysia, but the removal of the fuel subsidies next year will be a key moment.
The government is likely to carry out the petrol subsidy rationalization sometime in mid-2025, according to the federal budget. This is intended to impact only around 15% of the population and will likely raise overall inflation significantly. But as of now, given the stable growth and inflation outlook, we think B&M will keep the policy rate unchanged at 3% in 2024.
Arindam Chakraborty there. Now, in part 2 of a bonus deep dive interview with ANZ Group Chief Economist Richard Yetsenga after his recent trips to China and India, Richard talks about how China's authorities will learn lessons for next time about how to support growth. And he compares what he saw on those 2 trips. So what lessons do you think will be taken from this package coming out of China over the next few years?
It's difficult to know, I think, because there hasn't been an overarching narrative to this. We call it a stimulus. It's really a sequence of policy packages from different departments, and certainly that is a message in itself. Ministry of Finance, Ministry of Commerce, National Development Reform Commission, the China Bank Regulatory Commission, the People's Bank of China, the department responsible for housing, others, all of these have announced policies of their own. There doesn't seem to have been an overarching narrative to knit that together, but certainly I would think this sort of period is going to be repeated in the future. The drags on the economy are substantial, and they reflect a natural evolution after a strong period of growth in debt and a period where the population started to decline, particularly in an economy which is quite trade dependent, where obviously the world has been shifting in a direction which is less trade friendly. All of these things suggest to me that China will need more reform packages in the future of the type designed to stabilize the economy and try and boost growth than we have been used to in the last 10 or 20 years.
So, Richard, you've been to India recently, which, along with China, is growing its manufacturing base. Do you get a sense of, looking at those two economies, the similarities, or are the differences growing based on your two trips?
I don't know whether similarities dominate or the differences dominate, in all honesty. I suppose that they've both. China has been such a unique story the last couple of decades. It's almost inconceivable to think India will follow a track that is anything like that. Certainly the international environment is very different. The climate environment is very different. But in terms of economic heft, India can in some way follow in the footsteps that China has been on. China has shifted in the last 30 years from a production economy to the production economy. China has shifted from a trading nation to the trading nation. China has shifted from just a member of the pack in terms of economic heft to be the second largest economy in the world. I mean, India is not going to catch up with China tomorrow, but certainly over the next decade, India's GDP could grow to somewhere around half of where China's GDP is today, and it could certainly be a very substantial player in sectors that end up suiting its style of development.
And just looking at the risks for China and India in terms of trade, particularly if a Trump presidency prevails, what's the outlook there?
The US election is the global topic. It doesn't matter where you are and who you speak to. Everybody has an interest, and it makes sense. The US economy is nearly 25% of world GDP. You have this sense it's a bit of the engine room of the global economy at the current point in time. I think everyone outside the US rightly has a concern about a US administration which might be overtly more protectionist and less discriminatory in the way it applies that protectionist slant. All will be revealed by mid-November.
Richard Yetsenga there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Friday, October the 25th. Catch you next week with a Bank of Japan rate decision and Australia's September quarter inflation data. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.